What is going on, guys? Welcome back to Carl's Economics. In today's video, I will be reviewing the Fed's decision to not increase interest rates, as well as CPI and unemployment rate. And again, this pertains mostly to America, but we all know that the Fed's decision in America has a large effect to the global economy. So that's why I'm reviewing this today. Two things I want to go over today as it pertains to this press conference that was held. The uncertainty amount that these people are talking about is absolutely absurd, right? And you can say that it's for a multitude of reasons, but ultimately the reason why they're looking at it like this is purely for the fact of staying apolitical, which ultimately doesn't make any sense when it comes to a central bank, because they're supposed to be there to hold governments liable for decisions that affect the market, right? Which, if we look at the economy in of itself, like, there's not high confidence in what's going on right now, right? So we're also going to be going over some of the two questions that the reporters had asked during the question period. One was about, again, consumer confidence, and the other one is about employment. And before that, though, I do want to go over just a few things here, just so you guys can see what I'm talking about. So let's go ahead and put me down there. So, like I was saying, guys, CPI is not looking the best right now. I mean, it's not looking bad, right? Like, we're not looking at peak pandemic level CPI, but we're still looking at pretty much mid-level pandemic, right? Like 2021, 2023 levels. And why is that? Like, why are we looking at a level of CPI that is like almost similar to pandemic levels when we're supposed to be coming off of that, right? Well, it comes down to very simply the fact that as much as the Fed didn't lower interest rates today, don't get me wrong, that would probably be looking into a recession, right? If they lowered interest rates, I bet that would be a very key indicator that we're not looking into a good economy. But the reason why we're looking at this is because, guys, they can't increase interest rates either. Like, that's not something that they can do right now, because if you look at consumer debt as well as business debt, it's at the highest levels ever recorded, right? And that means that you can't just increase interest rates to try to boost the economy and decrease inflation, because then you have pretty much a bubble. You have a bubble, and then we're looking at another 2008, and it's not 2008 because that pertains to housing, but we're looking at debt, right? Like credit card debt, we're looking at business loans debt, we're looking at student loan debt, we're looking at massive levels of debt, and this is the reason why they couldn't increase interest rates either today in order to combat this inflation that has just only been increasing, right, since the end of COVID, right? And again, I'm not going to say super increase, but like, look at this. This is volatile. Like, this is volatile as hell. Like, this is not consistent. This is not going down, and this is just volatile. Like, and we're going back up. So, guys, I wanted to go over the report and just show you guys a couple things here as it pertains to, number one, the unemployment rate. As we can see here, when it comes to the unemployment rate, like I was saying, we're looking at almost pretty much like pandemic level unemployment rate, right? And it's like, why is the unemployment rate this high, right? Like, we're looking at an upward trend of unemployment rate, and it just doesn't make any sense. It doesn't make any sense, right? And again, in the question period, they actually go over why they think unemployment rate is so understated, right? And I'll explain that a little bit later to the video. But one thing I definitely wanted to go over here was this GDP. This real change of GDP from 2025 to 2027 over the long run projections in the Federal Reserve. Guys, look at this. Like, what is this volatility? Like, we got a bear over here, we have a bull over here, and again, like in 2026, 2027, 2025, they're projecting 1.5, anywhere from 1 to 1.8. Again, I don't know what this bull is over here. I don't know what this chair representative is thinking, but look at this volatility. We're looking at like from 0.6 to 2.4. What is that? And then you look at 2027 as well. Again, there's a bear and there's a bull. And look at that volatility. Look at how uncertain that is, right? We should be looking at levels that are like right here probably, right? All of the Fed should be in this box. It should be in that box, right? But we're looking at an extremely volatile Federal Reserve that it just doesn't know what the fuck's going on right now. It generally doesn't know what's going on, right? And it's trying to stay as apolitical as possible. But again, it's just not working out for them. It really is not working out for them. So the other thing I wanted to look at when it came to this report here was, again, this uncertainty that I was talking about, right? This uncertainty that the Fed is talking about when it comes to the risks around economic projections. It's just increasing, right? This was the projection, and we're already up like almost 2 or 3 points of uncertainty. And it's like, how can a central bank that is so concentrated on soft projection as opposed to hard data be this uncertain when it comes to the economy? I mean, this is what their job is, right? Their job is to make sure that this economy, at least the American economy, is in working shape. But of course, they're just like, I don't know, it's uncertain. It's uncertain, right? And that uncertainty is only going up. So I don't think there was anything else that I wanted to review in here. I just wanted to show you guys uncertainty, and I wanted to show you guys that bull and that bear when it comes to real GDP growth. What is that? That is so volatile. I'll go back to that page because, like, what is this? Seriously, 2026, one person. 2027, one person. And it's just, it makes no sense. It makes absolutely no sense. It has never been like this. And again, I think it's only because the fact that the Fed is just trying to stay apolitical, which is not their responsibility. It's really not their responsibility, right? So that was pretty much the basis of what the Fed was talking about today. Again, like I said, they can't increase interest rates, right? So we're in this period of stagflation again, going back to periods of 2006, 2007 of stagflation. And if they do lower interest rates, again, like I said, we're looking at a bubble, right? So there's I can kind of understand where they're coming from when it comes to this uncertainty. But again, it's their responsibility to ensure that that isn't there, right? That consumers at least have projections for, you know, a more positive outlook or even a more negative outlook, right? What we've received today is just everything is fine, like that meme, right? That this is fine with the fire in the background, this, that, and the other thing. We didn't get any hard data today, any hard data that actually represents what is going to happen. It's just all volatility, it's all uncertainty, and yeah, I just don't know what else to say except for that, guys, when it comes to the introductory statement. So we're going to move into the question period. I wanted to go over 2 questions, or at least show you guys 2 questions that were asked to the Federal Reserve Chair, Powell here. So let's go ahead and play this for you guys.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices, it's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So So I think if you, yeah, I mean, remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think, and unemployment is really, there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people have said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary.
So, again, he says that word that is going to pop up if you guys watch the whole conference a million times. Uncertain, 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 uncertain. Why is it uncertain? Is it tariffs that is making it uncertain? Is it this, that, and the other thing? Again, he doesn't want to say, right? He doesn't want to say exactly what's going on here. That, they don't cancel each other out. That's not how that works. That's a complete lie. And the only reason why inflation is increasing is because he cannot raise interest rates. He can't, because consumer and business debt is so high to the point where they would create a bubble, right? So that was a great question from that reporter, and I just wanted to go over that really quickly because he says that they cancel each other out. Well, they don't, guys. That's not how that works, okay? That is not how that works. And the only reason that the inflation is going up is, again, because he cannot combat that with higher interest rates in order to make consumers pay higher interest rates. So let's go over this next question like I was talking about with employment. I thought this was another great question, so I'll go ahead and play it for you guys here.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring, but we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw it. We've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that.
So that second part of that question, this question was from a Fox Business analyst, and so the second part of that question I'm just going to disregard because he pretty much just wants the Fed to say, oh, Trump's policies brought in, an increase in job growth and this, that, and the other thing. So he kind of skirted through that question and was just like, I don't really know. But guys, what we need to realize is that first part of that question. he states that if layoffs increase in numbers, we could see a massive growth in unemployment rates, right? So, as much as, yes, everybody might have a job and this, that, and the other thing, what happens when layoffs start, right? Due to either recession fears or tariff implications. And once those layoffs come through, and if they come through, then you're looking at a very, very bad problem, because then you have debt, massive consumer debt stacked on top of an increasing unemployment number. And again, we just looked at the charts. This unemployment isn't going down, right? It's not going down. It's only been going up since 2023. So, guys, when it comes to the economy in of itself, right? Like I said, the Federal Reserve is kind of just like, this is fine, right? Well, the fire is burning behind them, and because they can't do anything, they're in a period of stagflation. They cannot increase interest rates to help their cause, and they have to watch it burn, right? So, here's the thing. We could definitely see, with new policies being introduced, this, that, and the other thing, that unemployment doesn't start, decreasing. But, I mean, come on, with tariffs, with recession fears, and consumer confidence going down, guys, I don't think that unemployment is going down anytime soon. And once you have that high unemployment rate with the amount of consumer debt that has been happening, as well as business debt, even though that's not really as big as consumer debt, excuse me, once that happens, we're looking at a massive bubble, right? And again, I'm not trying to fearmonger here or anything. I'm just giving you the data and giving you exactly what these people are talking about. And he said it himself. Once we have layoffs starting to occur, with the slow amount of hiring that has been going on, right? You got a problem here. People have jobs, right? But if people start losing them, that's where a problem's going to start occurring, right? So, guys, that was pretty much the whole gist of the Federal Reserve press conference today. Again, two massive words that occurred throughout that whole thing. Well, maybe not two that occurred through the whole thing, but one massive word that occurred through the whole thing, and a consequence of what's going on right now. Uncertainty was the word. Guys, if I could make $1 off of every single time these people said uncertainty, or I don't know, I'd be a millionaire, right? And the second part of that would be the consequences of what's going on right now is simply stagflation. Like I explained earlier and several times through this video, the Federal Reserve cannot increase interest rates in order to combat inflation, and they can't lower interest rates because then they'll create a bubble. Guys, I really appreciate you watching the video today. I know it was a little bit of a longer video, but we had a lot to go over today, and yeah. Anyways, really appreciate you guys for watching. I'll make sure to catch you guys in the next one. Peace.